So as I'm reading up on the housing market, I've been asking myself a question for a while now. Are we seeing the end of first-time homeownership the way we've grown to understand the concept? Now, why are we asking this question? Well, we have millions of families across the country, many of which are in underserved communities who have been working tirelessly for years with the hope of one day purchasing a home. But that dream of owning a home is becoming less and less attainable, and here's why. We're in a hot housing market right now, what many would call a seller's market. Interest rates are low, there's a lot of liquidity in the market, and so prices everywhere are inflated, including home prices. Now, there's only a finite amount of housing stock in the market, and demand for homes is far outpacing the supply. And we all know that owning a home is one of the most viable pathways for building generational wealth, in addition to having an asset that you can collateralize if you need credit from a lender or a loan from a bank. The problem is there's a shortage of these starter homes, which are homes that first-time buyers would be in the market for. Now, according to the Wall Street Journal, the supply of entry-level housing is near a 5-decade low. Now, if we go back to the 1970s, an average of 418,000 new units of entry-level housing were being built each year, while for 2020, we only built just 65,000 new entry-level homes. Look at this chart here showing a steady decline of starter homes over time. And here's why this is such an issue. An analysis from the Urban Institute shows that homeowners between the ages of 25 and 34 accumulated $150,000 in median housing wealth by their early 60s. Meanwhile, those who waited until the ages of 35 and 44 to buy a home netted $72,000 less in median housing wealth. Now, obviously, cities like New York and San Francisco are notorious for unaffordable housing prices, but as we look around the country, we see many areas facing the same issue. And remember, this generation of millennials and Gen Zers are saddling themselves with thousands of dollars in college debt, making it even more difficult for them to compete in this housing market. But now that you all know there's a shortage of starter homes, you're probably asking yourself, well, we must be building more homes to meet demand, right? Sorry to disappoint, but no, we're not, and here's how we know. Building permits are an indicator of future construction, and according to The Real Deal, building permits declined in June to 100,000 below the 6-month average. Now, why are home builders not building as much? Well, there are a few reasons. The cost of materials are extraordinarily high, even though the cost of lumber did come back down. Regulatory costs are increasingly expensive with all the red tape you have to navigate for approvals. And there's still a critical skilled labor shortage in the construction industry. Now, since there aren't enough homes being built to meet demand, prices are shooting up. The median sale price of a new home was 18% higher in May of 2021 than a year earlier. And so I began to ask the question, who stands to benefit from these market inefficiencies? And I came across an article in The Real Deal highlighting a new joint venture led by Tricon Residential, which is a Toronto-based investment firm planning to invest $5 billion into thousands of single-family rental homes across the Sun Belt. And the Sun Belt includes states like Alabama, Florida, Georgia, and yes, Texas, a state we often think of as an affordable alternative to the expensive coast states. So according to this article, Tricon is partnering with the Teacher Retirement System of Texas. This is literally the fund that manages the pensions of teachers across Texas, and Pacific Life Insurance Company, which creates one of the largest deals in the single-family sector's history. Now, Tricon expects to acquire more than 18,000 single-family rental homes in the next 3 years, and instead of building new homes, they'll be purchasing existing homes and entire home communities. This deal is in addition to the 9,000 homes they acquired in a previous partnership. Now, this is only one firm and only a couple of deals, but we're seeing more institutional investors and private equity firms invest in this asset class. Back in June, we saw Blackstone, another large investment firm, acquire Home Partners of America, which already owned more than 17,000 homes across the US. And more recently, we saw Jay-Z's Roc Nation and Will Smith's Dreamers venture capital firm invest $165 million into Landis Technologies, which is a company claiming to purchase homes in order to rent to clients until they can qualify for a mortgage. Landis says they aim to convert roughly 80% of its clients from renters to buyers a rate that would far exceed historical rent-to-own models. But many critics are skeptical of the rent-to-own model, which traditionally has failed to increase home ownership in any significant way. One has to question that if these prospective renters aren't in good enough shape financially to purchase a home, how can Landis help them turn that around within 2 years, coming out of a pandemic and not necessarily knowing which way the economy is going to move, especially considering the rise of COVID variants? According to a Bloomberg article exploring this deal, the client can buy the home back at a predetermined price up to 2 years after the initial acquisition. If a client isn't ready to buy the home back after 2 years, Landis may offer them more time or just sell the property. And so a few things stick out to me. One is that the 2-year threshold to purchase the home just may be not enough time. The other is that the rent-to-own model is notorious for requiring a balloon payment from the renter at some point. And if the renter was indeed responsible for repairing and improving the home during those first 2 years of renting, but can't then qualify for a mortgage after 2 years, will they just lose everything they put into their property? I'm just not convinced that this model is somehow different from the other rent-to-own models, except that they have some wealthy, influential celebrities attached to it. That said, my hope is that the Landis company isn't simply using Jay-Z and Will Smith's likeness to target Black and brown communities for potential home buyers, only to then trick them into the renter's trap, causing them to lose tens of thousands of dollars in the process. In due time, we'll find out if this company actually makes good on its goal to convert the vast majority of its renters into owners. In fact, I think certain executives' pay should be tied to those metrics. So with interest rates already low, financial markets riding high, and with little new housing stock to show for it, where does this leave the average person simply looking to purchase a home? Well, the reality is the rising home prices are going to turn a lot of buyers into renters, at least in the immediate. And if this is indeed a trend, and these institutional firms are buying up huge portions of the single-family housing stock without providing their renters with a viable option to buy at a fair market value, then we may very well see the death of home ownership for millions of prospective first-time buyers across this country. Well, that's all I have. Please like, share, subscribe if you enjoyed the content, and comment your thoughts below. More real estate content on the way.